So in terms of alternative investments, the key dynamic, as the name suggests, is they need to be different and distinct from traditional assets. So if you think of your traditional asset portfolio in terms of an exposure to equities, fixed interest, ultimately you're going to be susceptible to how those two assets perform in the long run. From an alternative perspective, there's a tremendous diversity in terms of asset class. So you're exposed to additional asset classes that you wouldn't be exposed to. There's also a huge diversity in terms of the investment styles from the managers. So there's a tremendous amount of flexibility in the investment style that you'll find within alternatives, which is important because as the environment changes, then you're able to adapt. And I think when we talk about the investment opportunity right now, you'll see that the opportunity has changed a lot, and therefore an ability for managers to adapt to that is an important component of the return. So I think in summary, alternatives are not susceptible ultimately to how the broader markets are performing in terms of equities and fixed interest. We're not looking and seeking to have any type of directionality towards those broader markets. Very different in terms of the diversity of asset class and investment style, and as a result the return lands up being very complementary to traditional assets. If you think of the world right now, it's extremely lopsided in terms of the economic growth that different economies are facing. About 25% of the global sort of growth or GDP is stagnating, whereas in the United States you're actually incurring or you're enjoying above trend growth rates that haven't been seen for 10 years. So that makes an increasing the opportunity set just in terms of the geographical divergence that's taking place. What's even more important though is that policymakers are now starting to step in and ultimately react to this divergence that's taking place from an economic perspective. And for policymakers, that means central banks and governments, where you're starting to see in the United States a normalization of interest rates. Quantitative easing has come to an end, whilst in areas like Europe, Japan, they're just getting started. So ultimately, the fact that policymakers are now beginning to step in is going to influence a lot of asset classes in a range of geographies. So as it relates to maybe just giving you a practical example, in terms of this global divergence, the portfolio has a healthy allocation to what we would call diversifiers. And in diversifiers, we have macro managers that have a very broad global perspective, are investing in very liquid asset classes, from equities to fixed interest, currencies, to commodities. And ultimately, as a lot of these changes are beginning to take place, various governments and central banks are stepping in response to what's been happening, you're going to be starting to see these asset classes move significantly. To have a manager that's not constrained, can think and can approach the market from a global perspective and be highly adaptive in their positioning is going to be very important in ultimately generating a return out of this opportunity set that we spent some time on. In terms of additional sort of investment opportunities that will arise from what's taken place in the last few weeks and months in the area of oil and the oil sector, is in the area of credit. So if you think of a large component of the companies that have actually come to the market and issued debt in the last few years, a very large component of the high yield issuers have actually come out of the energy sector. And it's not surprising because certainly drilling for oil in the United States is a very capital intensive process in that the wells ultimately need to be replenished every 3 years. So the high yield market has over 20% now of its essentially makeup being the energy sector. Well, what's going to happen because of ultimately low oil prices is the profitability of these businesses is ultimately going to be much more challenged. So as a result, the cost of capital or the price that they can raise capital from the market is going up. So it's very important with some of our alpha managers in the portfolio that they're able to essentially underwrite or research in a huge amount of detail some of these companies that will be needing additional capital to continue their drilling operations, their exploration, their production in the coming years, but ultimately will be demanding a much higher price, which is ultimately a much higher rate of return for us, the investor. But it's important to be able to research these businesses to ensure that the viability of these businesses in the long run. So here I see returns ultimately improving because the cost of capital is going to go up, and you need an alpha manager to really conduct the research process on these circumstances or individual companies on a case-by-case basis.